One of the largest penalties in the IRS code is if you don't take out the proper amount for your required minimum distribution. The penalty is 50%. In this video, I want to share with you not only the new rules that are out for 2022, but also how you can avoid this very hefty penalty. But before we get there, click on our channel and subscribe to it. Hit the notifications bell so you can be alerted to when we post new videos. I have over 30 years experience here, and I want to share with you what I've learned and the conversations I have with my clients so you can avoid some of the landmines they may have stepped on. So I want to share with you, in a sense, sort of what my role is with my clients in our office, what we do for them, because it relates to this particular topic. We serve in a number of different roles and a number of different capacities for and with our clients. But the number one topic that we deal with, the most important issue for our retirees, particularly for those who are over 72, is making sure that they manage the required minimum distributions properly, because we do not want to have them subject to this type of fee. So let me share with you what I'm going to go over today with regards to required minimum distributions, or short RMDs. First, why are these rules put in place? Second, what are the actual RMD rules? Third, the new guidelines just put in place starting for 2022. And finally, a tip to help you so that you can actually avoid being forced to take money out of your IRA and having that money taxed. So let's get to it. So why are these rules in place? Well, if you think about it and put it in context, for numbers of years, where depending upon how old you are, for the last 20, 30, 40, 50 years, you've had the opportunity to have money in your IRAs or your 401ks or your 403bs, your retirement accounts, grow tax deferred. And at some point, what the government is basically saying, we need for you to start moving that money out so we can transfer it to a situation where the government can get some benefit from that, where they will be able to tax you on your income. The ability for you to just defer this forever is not a formula that the government feels like is in their best interest. So what are the rules? What do you have to be considering as you think about these required minimum distributions? So what is a required minimum distribution? So the RMD is the minimum amount you must take out of not only your IRAs, but your retirement accounts, including 401ks, 403bs, SEPs, etc. Once you attain the age of either 70 and a half in the year 2020, or the age of 72 in the year 2022. One thing to remember is that there is a separate retirement account, the Roth account, which is not mandated or regulated by forcing you to take out RMDs. This is a part of a conversation that we have with our clients about diversification. Now, you've heard the term diversification with regards to money management, I'm sure. But if you thought of it also with regards to your retirement accounts and diversifying the different types of retirement accounts so you have more control over when you take money out and whether or not it will be taxed. This is one of those conversations you should be having with your advisor. So when must you begin to start taking out your required minimum distributions? So let's assume for this example that you are turning 72 in the year 2022. You must take out your first distribution by the end of 2022. Or you can defer that first distribution to the next year. Now, the caveat here is you must take out that first distribution if you do defer it a year by April 1st of 2023, and then take out that second distribution that you would normally take out by the age of 73 by the end of the year in 2023. So in essence, you have a choice for your first distribution. You can take it out in the year that you turn 72, or you can defer it to the next year, which would mean you would take out 2 distributions in that year. The answer to that lies in the planning. And again, go back to your advisor to find out what would be the best for you. One of the questions we get is whether or not you must take out your RMD if you have a SEP or simple IRA. And the answer is yes, you must. There are some exceptions for employer-sponsored plans, but for SEP and simple IRAs, you must take the RMD out by the time that you turn 72. What is the penalty for not taking out the proper amount? You will be fined 50% of the amount that you should have taken out. So let's think about this for just a moment. If you were supposed to take out $10,000 and you only took out $5,000, then the IRS is going to force you to not only take out the other $5,000, but also penalize you $2,500 for not taking out the right amount. So how is an IRA required minimum distribution calculated? So on December 31st of the previous year, that's your benchmark. That is the amount that is in your IRA or pool of retirement accounts. And from that number, let's call it $1 million, you then go to the life expectancy table, which is IRS publication 590. And there are 2 ways to take the distribution. One, if you have a beneficiary who is not a spouse, or your spouse is the beneficiary and he or she is not more than 10 years younger than you, you will use the single life expectancy table. The second way to calculate it is, again, going back to the December 31st values and multiplying the factor in a different way, and that is the joint and last survivor table. If your spouse is the beneficiary and he or she is more than 10 years younger than you are. Another question I get is, can I take out more than the minimum? And the answer is absolutely. The government just mandating you take out some level so that they can get their money, so they can get you taxed on the income that is generated by the RMD. You could take it all out. But remember, whatever you do take out, of everything but your Roth IRA, will be fully taxable at your income tax rates. Finally, and this is really important, from what account do I take the RMD? Now, this is the way you have to think about this, okay? Let's assume you have 5 different retirement accounts, a 401k, some IRAs, and they equal $100,000. In each of them, each has $20,000. So your pool of retirement assets is that $100,000. Now you will get a letter from each of those custodians of your retirement accounts indicating what the amount is you should be taking out from each account. The reality is you could take it all out of one account. You could split it between 3, 4, or 5 accounts. It doesn't matter. As long as you take the proper number from the pool of your retirement accounts, no one really cares which one it comes from. And herein lies a very important tip that we provide for our clients that I think you should be thinking about as well. Part of the issue with required minimum distributions is the fact that you may own so many different retirement type accounts, getting so many letters, and it may be confusing to you in terms of what you should be doing. We recommend to most of our clients, to the best of their ability, to consolidate as many of those accounts as possible in order to minimize the paperwork and minimize the confusion and try to eliminate any possibility that they would ever be subject to this 50% fine. So the question for you is, before I go on with a couple of very important tips for you and the new rules and regulations, are you really prepared for retirement? In my new book, Don't Outlive Your Money in Retirement, we actually created a quiz. You can go to our banner and hit the quiz. Invest 2 minutes of your own time. We will score it for you immediately, tell you which one of the 3 retirement preparedness stages you are in. I'll get you a free chapter of the book and some worksheets so you have some more clarity in terms of whether or not you are prepared for this next chapter. Now, it's important to understand I did not cover every possible avenue, every possible option that is out there. It's important for you to go to your advisor and make sure that you are taking out the right amount under the right circumstance so you don't get hit with this fine. Now, I want to go over very quickly the new rules and guidelines starting for 2022. So I said to you that in terms of calculating how much you need to bring out for your RMD, you go back to the previous year's December 31st values of the retirement assets, the pool of all of your retirement accounts outside of your Roth IRAs. And then you multiply it by a factor. And this is where the new rules and guidelines come into play. So the very first year, let's assume you're 72, and let's assume you have $1 million in your pool of retirement accounts. The first year's factor is approximately 3.6% of the value of what you had on December 31st. So 3.6% of the $1 million would mean that in that first year, you would need to take out $36,000. And remember that this is fully taxable. Make sure you have the proper withholdings. Each year thereafter, that amount goes up just a little bit more. Now, the interesting part of these guidelines is, and in the old guidelines, the life expectancy tables went out to the age of 113. Now, I don't know about you, but I don't know very many 113-year-olds. And what that in essence was saying was, the government is not going to force you to completely deplete your assets to get your RMDs. Well, for 2022 and beyond, that life expectancy actuarial table now goes to 120. So they've actually allowed you to take it out over a longer period of time. Finally, really important here, if you could avoid taking out the money out of your IRAs, would you be interested? If you could avoid not paying taxes on that money, would you be interested? Just to put this into context, many of my clients don't necessarily need the cash that is coming out of their IRAs, that is being forced at the age of 72, but they must take it out of the traditional IRAs, 401ks, 403bs, etc. But if you had converted a portion of your retirement assets to a Roth account, not only would you not be forced to take the money out at age 72, but any money that you do take out at the correct times would not be taxed. So this is where the planning comes into play, and make sure you take a look at our video with regards to whether or not a Roth is something that is good for you.